Back to your hosts, Eric Townsend and Patrick Ceresna.
Listeners, we'll keep bringing on second guests as conditions warrant until the Iran situation eventually settles down. Now, you'll find the download link for this week's Trade of the Week in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage and look for the red button over Matt Berry's picture saying, "Looking for the downloads."
Patrick, one of the most interesting points Matt Berry made this week is that AI may be destabilizing not just software valuations, but the private credit complex that financed so much of that software as a service growth. Is there any clean way to express that theme in public markets? And what's your trade of the week?
Yeah, and the way I want to express that is through the BIZD, which is one of the cleaner public market proxies for the BDC and private credit space. Matt's point is that these funding rounds are getting too large for equity. More companies are leaning on debt, and a meaningful chunk of private credit exposure sits against these SaaS businesses whose economics are now being challenged by AI. The problem is, the BIZD has already deteriorated materially last year, and even year to date is down 15+%. So I don't want to chase it with a simple outright short, especially because the fund carries a high distribution yield, which makes a physical short a pretty expensive negative carry position. So to me, the cleaner expression is through options, where we can buy downside convexity and make a more direct market call on the next leg lower. Now, the way I'd actually structure that is through the May 15th, 2026 in the money $13 put option, which has about 43 days to expiration. With the BIZD trading around $12.10, that option is offered at roughly $1.10, which means we're buying about 90 cents of intrinsic value and only paying around 20 cents in time premium, with a starting delta of roughly 65 cents. So what that does is give you immediate downside participation without having to fight the negative carry from the dividend, and you're doing it with very limited premium decay. In practical terms, it behaves like a synthetic short, but with defined risk. If the trade works and the BIZD continues to deteriorate, you've got direct downside exposure. But if the thesis is wrong and the market stabilizes or rallies, your loss is capped at roughly $1.10 premium paid, which is effectively similar to running about a 10% stop on the underlying over the 43-day window. So the idea here is to express Matt's private credit stress thesis with convex exposure, avoiding the negative carry of a physical short while still maintaining meaningful participation if this develops into a broader repricing of credit risk.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's take a dive into these equity markets.
Well, Patrick, I'm more than just a little bit concerned that futures markets are, at least at the time of recording late Wednesday night, not taking the potential outcomes in Iran as seriously as I am. President Trump didn't signal a ceasefire or immediate end of hostilities, as was widely anticipated by markets. Instead, he doubled down and said very explicitly, if no deal is reached, that the U.S. would be hitting Iran very hard, and he went on to say that that would include targeting Iran's civilian electric generation plants, probably simultaneously, simultaneous, take them all out at once. That would cause massive civilian casualties and bring rise to humanitarian objections from other nations and the United Nations as to, why the U.S. had taken that form of escalation. So I'm really hoping that this is just part of President Trump's negotiating strategy and not his true intention. More to the point, That's exactly the move, targeting Iran's civilian power infrastructure, that Iran has said in previous statements would cause them to retaliate by targeting both the Baraka nuclear power plant in the UAE and the desalination facilities that many of its neighbors, including Israel, rely heavily on for their drinking water. And of course, 3 weeks ago, Anas Al-Haji explained why that was such a big threat in our episode just after this war conflict broke out. So, in other words, the escalations that are being threatened now by both sides and being threatened imminently by both sides would lead to massive human suffering and civilian casualties and would be characterized as war crimes well outside of international law. Of course, we can hope that the president is just employing his usual tactic of making dire threats that are going to be walked back just as soon as a negotiation comes about. But in my opinion, we're playing with fire here, and the president's threats could provoke Iran to retaliate immediately, even before the threatened attacks on its civilian power infrastructure are undertaken by the United States. I'll be the first to admit, folks, that my own personal, very strong anti-war politics might be biasing my interpretation of these events, because I'm definitely reading them to be worse than it seems like the market reaction we've seen so far after the president's speech would indicate, based on what futures markets are doing. But I see this as a much bigger deal and a greater risk for widespread human suffering than other analysts seem to be willing to acknowledge. So I sincerely hope that I'm wrong. Everybody will laugh at me and ridicule me on Twitter, and we won't have millions of people dying needlessly. I'm just fine with that outcome. If I'm right, we could be headed toward a big escalation rather than the wind down of this conflict that markets have been anticipating based on the president's prior statements and social media posts. So my strong hope is that the White House will have walked back the threat of simultaneous attacks on all of Iran's nuclear electric power generation capability before you even hear this podcast. And I'll probably sound like the idiot in this story who overreacted. And again, I'm just fine with that outcome if it means that we're not going to escalate this conflict. The S&P is trading only modestly lower about 2 hours after the president's speech as I'm recording this, so far indicating that nobody else is as concerned as I am about what maybe is about to happen here. So let's all hope that they're all right and I'm completely wrong.
All right, Eric, I'm going to keep my analysis very simple from a technical perspective. We had a very significant March decline that saw almost a 10% drop in the markets, close to 700 S&P points. We were quite oversold. We were close to 400 S&P points below the 50-day moving average. So typically when the market is stretched that way, it often has a retracement. And so that's what we got here, a bounce on the upside that took a shot towards its 50-day moving average, even though we haven't hit that yet, which still lies around 6,800 on the S&P. Bottom line here is that this is an oversold bounce. There's zero evidence that a market bottom is in. And so if this entire rally here fails and stays below this 50-day moving average, we have to anticipate that another leg down in these markets is entirely on the table. All right, Eric, let's touch on this dollar.
The Dixie is 99.77 2 hours after Trump's speech. Not a huge dislocation. No further evidence that the market, again, is as concerned as I am about what felt to me like a much more escalatory speech from President Trump than I and the market were expecting. I don't really have any strong view on what happens next here. I think that the stage is set once this conflict is over for the dollar to weaken and weaken a lot. I think the U.S. is losing ground in terms of its international reputation, and there are signs of other central banks really questioning their commitment to U.S. Treasuries as a principal reserve asset. Whether or not that actually results in the dollar turning down soon, or if we get a massive increase in the dollar index in a flight to safety trade that's brought about by a war escalation, I don't know. I could easily see up before down, but I think the ultimate resolution to this for the dollar index is going to be down and down to new lows.
Well, Eric, I'm a little more technically bullish here on the dollar than most. Overall, we've been consolidating along the top of an 8-month month trade range. But the dollar has now a tailwind. We continue to see, obviously, the geopolitical landscape pivot, which is causing all sorts of intermarket influences, including stresses on economies like the Eurozone, which could see the euro weaken. If this dollar can sustain above this 100 level and especially break out to a fresh high, which is just slightly above the 100.5 level, we can see a little bit of a shoot on the upside of this dollar to 102, 103 very easily. I think there's some room for dollar to go, and I'm definitely watching for that follow through on the upside. All right, Eric, let's touch on this crude oil chart.
West Texas Intermediate crude spiked up about $7 on the president's speech. It had started to retrace around 10 p.m. or so Eastern time. As I'm recording this, it looks like we're pushing back above 105, so we're up to almost $8 of higher oil price than before the president's speech. I think it's headed considerably higher. Now, if we get the deal that the president has alluded to, if they really do have a negotiation underway, which the president didn't really comment on either way, he just said if no deal is made, the consequences would be dire. Hopefully he's just using that as a threat to push a negotiation along, and perhaps by the time you've heard this, the negotiation will be over and we'll be back down to $90 crude oil or $80 crude oil. I don't know. It could go down really hard if this is ending rather than escalating. So the question to ask is whether this conflict is finally winding down or if it's about to escalate. Form your own opinion. As I've said, mine is admittedly biased, but I'm just concerned by the very, very aggressive approach that the president is taking to doubling down on his threats to escalate to attacks on civilian power infrastructure.
Well, Eric, there's no denying that this is going to be directly based upon the escalation and what is happening here in the Middle East. From a pure technical perspective, this uptrend is very pronounced. All dips are being bought. The crude oil continues to edge higher. At this stage, when we're looking at the West Texas Intermediate here, we could easily see us retest the $120 high here, where it printed on an intraday basis in early March. All right, let's touch on gold here.
Patrick, gold has rallied very strongly over the last few daily sessions, seemingly anticipating a wind down of the Iran conflict and a removal of the threat of the Fed's hands being tied by oil-driven inflation, basically taking rate cuts off the table. And that's really what the risk is if there's going to be oil price-driven inflation, it means that it's not possible to cut rates. And that really gets in the way of gold being able to rally because gold doesn't produce any return and it competes with treasuries. So as treasury returns are getting higher, gold still doesn't yield anything. And the cuts that would make gold more competitive by bringing down that yield on treasuries are off the table for policy reasons. So that's the mechanism for why it's happened. And indeed, gold has been down, oh boy, let's see, I'm recording a couple of hours later now as we got into this, from 48.17 all the way down to it bottomed at 45.79, and as I'm recording, we're back up to about 46.65 or so. We're talking multi-hundreds of dollars down, more than $220 down, it looks like, at the worst moment there on gold. I don't think it's going to go all the way back, though, because what we have seen is a change of correlations. When this whole crisis started, you were seeing oil goes up, gold goes down, and it seemed to be a very tight correlation that more and more people started unwinding gold. One thing led to another. The CTAs were unwinding. A very, very crowded gold trade was forced to unwind. I think that big forced unwinding has pretty much played out now. Most of the people that were going to get washed out of that trade already got washed out of that trade. Some of them started stepping back into it over the last week. They're paying for that this morning. as we're seeing gold prices moving back down as oil moves back up, as President Trump has made it clear that he's not done yet with this assault or situation in Iran. So coming back to the big picture, though, in the end, are we really going to see treasuries become all of the central bank's favorites and they don't want gold anymore? I really don't think so. So in the short run, there's plenty of room for an oil price-driven inflation signal to create a tailwind for gold that pushes us back down, but I don't think it's going to get us back down to that 4,100 level where the 200-day moving average is. I'll be very surprised if we end up moving below that level. So my interpretation is that gold is ready to rally back to new all-time highs, up to 6,000, just as soon as the threat of persistent oil-induced inflation is taken completely and totally off the table, and the Fed is able to consider cutting again. The market thought that might be just around the corner, and then President Trump's announcement Wednesday night pretty much nixed that one, at least for the short term. So now it's no longer looking like oil-driven inflation is off the table. Gold is going to correct lower. It's already down a couple $100 just since the president spoke. The question is whether the lows below the 200-day moving average are coming back into play, and I don't think they will be. What we've seen since that test of the 200-day moving average is a change of correlations where you see oil prices and gold prices going up at the same time like they used to. So that inverse correlation seems to be coming out of the system. The hot money that piled back into gold over the last few days is probably piling back out this morning. But I think that we're eventually going to set the stage here for a sustained rally back up to $6,000 gold. I just don't know when it starts. I don't know how deep we dip before we get there. But I think last week on the show I was saying, we could see gold all the way down to 3,000 or 3,500. I'll be really surprised if we get a sustained move below 4,000 at this point. But anything's possible.
Eric, so that test of the 4,800 level on gold was a direct hit of the 50% retracement and the 50-day moving average. Overall, we are in the precious metal space in a correction phase. Now, I remain big picture quite bullish gold and silver, but the price action is showing that we're in the midst of some sort of reversion. We went through a 2-year bull phase on gold that was quite an uninterrupted advance, and what we clearly have here is the first legitimate market correction in 2 years on gold. And so at this stage, we want to see how this plays out. These could be a multi-month consolidation, will lead to an extraordinary buying opportunity. But here, if we're failing and trading below 4,800, then a retest of its previous low near 4,200 or even a test of 4,000 is entirely plausible. Again, I would use all those types of drops as buying opportunities, but these are the short-term risks in terms of the flows. All right, let's touch on uranium here.
Well, Patrick, the fundamentals are super uber bullish. Couldn't really be much better, and they are getting better day by day as we see more and more U.S. government nuclear announcements, more commitment to nuclear energy, more and more people coming around and looking at this oil crisis and using that as justification to say, boy, we really need to rethink our strategy and focus on nuclear energy is where we make our big investments. So it's all going super strong. But I have to acknowledge there is a new risk, a new elephant in the room, if you will, and it's a big, fat elephant. That new risk is the outlier risk of one side or the other intentionally targeting and operating civil nuclear power plant as a military target. Now, that would be in direct violation of Article 56 of the 1977 additions to the Geneva Conventions, so it would be an act of war if anybody did it. But guess what? We've already done it. Somebody's already done it. What the Article 56 says is you cannot target any nuclear electric generation power plant. There are some exemptions for military plutonium production reactors and so forth that can be military targets. But if it's a civilian nuclear power plant, like the Basra power plant that they have in Iran, it is a Article 56 violation of international law to target that. Well, guess what? They've had 3 airstrikes. I don't know if it was U.S. or American airstrikes or both, but they've been hit 3 times in what, as far as I can see, is an Article 6 violation. Now, so far, they're not aiming for the containment. They're not trying to breach the reactor containment, which would have the effect of splattering radioactive contamination across a wide area and creating a disaster that's bigger than Chernobyl by maybe a full order of magnitude. That would be the risk if, say, Iran were to send one of their ballistic missiles right through the reactor containment building at the Baraka nuclear power plant in UAE, as they have threatened to do already. Now, when they built Baraka, they saw this coming. They've done a lot to harden that plant. But at the end of the day, with you're dealing with Mach 14 supersonic or hypersonic missiles, they can go through a lot of armor and they cannot be shot down with normal missile defenses. So far, it is unthinkable that anyone would violate international law and do such a horrible thing. Then again, just a couple weeks ago, it was unthinkable that anyone on any side would do a truly horrible war crime like, oh, I don't know, let's say targeting a girls' elementary school. But they did that twice in 40 minutes. Major nuclear accidents like Chernobyl, when they have happened in the past as accidents, have set the nuclear power industry back by 15 years when they happen. The public gets irrational and fears that a nuclear accident is somehow going to cause the nuclear plant to blow up like a nuclear bomb. It just doesn't work that way. That's not a realistic risk, but the public perception goes in that direction. So an intentional breach of containment of an operating nuclear power reactor, like the ones at Bushehr in Iran or Baraka in the UAE, could cause a contamination event an order of magnitude worse than Chernobyl. We don't know exactly how the public would respond if that happens. Would they say, oh, well, it was just an act of war and acts of war happen? Or would they say, we shouldn't have these nuclear power plants because they could be targeted during acts of war? No military in the history of the human race has ever intentionally targeted a operating nuclear reactor core and tried to breach its containment intentionally as an act of war. That's always been off limits. Nobody's ever crossed that red line. I sure hope that they don't in this conflict, but as Anas Al-Haji said, there's a lot of people that don't seem to see any red lines, and they're crossing every line. I consider this still to be an outlier risk. It's something that could happen, but if it did, it would sabotage the entire nuclear power renaissance, which in my opinion is the only viable option that humanity has to avoid a global energy crisis in the 2030s and 40s. So we really need nuclear energy. We need it for our survival. It is absolutely essential to the future of humanity that we not screw this up. And the way to screw it up, potentially, is not some accident or poorly designed reactor, but somebody firing a missile at a perfectly good nuclear reactor will make a mess. And if that happens, public sentiment could change on a dime. So as long as the unthinkable doesn't happen, any weakness on uranium stocks from this war is a buy-the-dip opportunity. It's the story couldn't be brighter for nuclear energy than it is right now, unless we actually have a military strike that blows up a nuclear power plant and splatters radioactive core material all over the countryside. That would be a really, really big deal.
Well, Eric, uranium is turning up here on the charts. Overall, it's been a structurally bullish chart. It's been consolidating for almost 2 months, but we'll see whether or not this can potentially create this breakout on the upside. Certainly looking for that bullish follow through at this stage with the primary trend being intact. Finally, let's touch on copper here.
Well, Patrick, we're bouncing nicely off the 200-day moving average, but still well south of the 50-day moving average, which is now turned down. It's pointed down toward the 200. We're still more than a month away from a death cross risk on that chart, but a prolonged escalation of the Iran conflict could bring that outcome. Let's hope that we get this Iran thing wrapped up soon and can move on here. To my eye, markets across the board are coiled up and ready to respond to the upside as soon as we get a real, true all clear. We're wrapping this thing up. Iran has agreed. We're all on the same page. A treaty was signed. We're going to wrap this thing up. I think it takes the stock market back to new all-time highs. I think it takes copper up. I think it takes uranium up. I think everything goes from there. The thing is, President Trump's latest news, he's playing a tougher ball game than Ronald Reagan was in terms of playing hardball with competitors, and it worked for Reagan. He managed to do some bluffing tactics that a lot of people thought were reckless, and he ended up winning in the end. And I hope that President Trump can be so lucky or so successful, but to my eye, he's taking some pretty reckless risks.
To me, Eric, copper has been tracking the precious metals markets for some reason. I mean, it's an industrial metal. I'm not sure why such a correlation should exist, but it seems like tick by tick we're tracking copper with things like gold. Overall, we got a bounce about the same time as the precious metals did, approached its 50-day moving average. We're in the midst of some sort of bigger global economic slowdown. With the behavior on the technical charts looking like this, there's room for this correction in copper to continue. A failure here on copper below 575 leaves lots of room for copper to head back down to the 5 handle on the downside.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Yeah, finally on that 10-year Treasury yield, we continue to see it trading at multi-month highs, and we're right now trading around that 437 level. While certainly there's room for some short-term volatility here in yields, but I suspect that the ceiling will likely hold here in this 4.5 to 460 level on the upside, and so we'll watch for that resistance and see when yields actually start to lighten up based on potential economic weakness. Certainly, this is the struggle of higher inflation prints and a slower economy. Which one will prevail in the yields?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thanks for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.